Good morning, Jags, and good morning, gang. How's everyone doing?
Doing good.
Good.
Another early morning. A lot of data coming out today.
Yeah. Well, there's an interesting news that is just hitting the wires a couple minutes ago. Baidu, take a look at the intraday price action. Just a couple minutes ago, there was a sharp dip of about $7, $8, and then a quick rebound. And it turns out that this article is coming out in Routers just a few minutes ago. Baidu is voluntarily considering leaving NASDAQ to boost valuation. It's voluntarily considering delisting itself out of the United States. And now they're doing this in terms of, I think one can easily make an argument that this is potentially because of the pressure that maybe some of these Chinese companies are feeling after the Senate bill that happened yesterday, which gives the power to the United States government to delist any of the Chinese companies. But here, less than 24 hours later, this news is out in Routers, and I wonder if this is going to set in motion new things to come regarding all the Chinese equities that are listed here. So something to keep an eye out. I think it's very interesting that this is rather happening in a brisk pace. And if they're considering this, and I think then there's a lot of other companies that will probably do the same. So we'll probably hear more of that. So something to keep an eye out. Okay, on the S&P, we're back to talking about the same thing over and over again. The 200-day moving average and the major VOP resistance at 3,000 level. The chart continues to attack that resistance at 3,000. We have weekly jobless claims that are coming out at 8:30, so in about 13 minutes from now. Not that it will matter because the initial jobless claims, the estimates on the street is once again a very large number of 2 million. But I'm no longer paying attention to the weekly initial jobless claims anymore. For my sake, what I'm paying attention to is the continuing claim. I think that is a far more important metric to understand whether the unemployment rate has peaked in this country and is starting to trend down. What I mean by that is if you simply Google search the continuing claims and you pull up this website from the Federal Reserve, St. Louis Fed, you will see that this is the continuing claims. It's been on a stealth increase. The trend started to slow a little bit week over week in the past 2 weeks. It was 22.3 million, and now it's 22.8 million. But what I am most interested in is finding out whether this is going to start declining from here, or is it going to flatline even? Let's suppose that you have 1.5 or 2 million of initial jobless claims that comes out today, but when you deeply dive into the report, you find out a lot of people are getting back to work. So formerly people that filed the claims are now dropping off the accumulation trends, which is the continuing claims. That's essentially an offset to what would be an ugly initial jobless claims, and that technically could be bullish because that would signify that we have potentially seen the peak in the unemployment claims and potential labor market. So 22.8 million is still a very ugly number as of last week. This equates to about 15-16% of the total labor workforce. But something to watch. So we'll update this in the chat room once the data is out. That's what I'm watching from a macro standpoint. Now, I do have one stock that I want to cover, and that stock is RTX, Raytheon Tech. We haven't looked at this in a while, and I think it's important to bring this up to the attention. Now, my math that I put together a little bit on this one last night. Here's what we need to keep in mind. First, Raytheon merged with United Tech last year, and so now the symbol has changed. It has become one of the largest conglomerates of both defense as well as cyclicals. So with the stock trading at $57 per share and down considerably from February high of $95 to $100 per share, it's down more like 45% over the course of last 3 months. The question becomes, is this the worst now, or is the worst likely already baked in? On what is my downside risk over here? Let's say, let's say if the market continues to fall apart and the valuation theme that we have talked about does not return anytime soon, versus what is the upside potential over the course of next year or so. And I'm starting to like the asymmetric risk reward that I'm seeing on my end. So let me just give you some color. Raytheon as a standalone company last year delivered $3.5 billion in free cash flow. Similarly, United Tech also delivered same exact amount pretty much. That's why it was equal merger of $3.5 billion free cash flow last year. So when you add the two together, that's about $7.1 billion of free cash flow, equates to about $4.64 per share. As far as the Raytheon component is concerned, 100% of that comes from military defense, providing all those Tomahawk missiles and all of that. All of that is pretty secure. There is absolutely no deterioration in those government spending metrics. On the United Tech side, which is far more cyclical in nature, it can be argued, according to my math, that PNW and the Collins component, which is the actual defense piece of the United Tech, it's about 25% of the company that comes from defense military spending, while the 75% is mostly cyclical, which is tied to the commercial airspace cycle. So if we take the United Tech defense piece and we add the Raytheon defense piece together, for a combined company, we can reasonably estimate that about 62.5% of the combined company's free cash flow is highly defensible in nature. We will not see any kind of deterioration in that metrics at all. So the stock is already down 45% from its 52-week high, and yet 62% of its business is highly defensible. When you apply the 15 times multiple on this, which is the same as historic multiple, you basically come to a valuation which is about $56 per share, and the stock is trading at $57 per share over here. And then what is to say that the commercial aerospace business that came from the United Tech will not see some sort of recovery in the long run? Market has to believe that it's not a zero component, right? Because that's a significant piece of the total company. It is tied to the commercial aerospace, but what I'm doing for my sake is if I zero that out, I mean, imagine how such a large chunk of United Tech, 75% of that business, I'm zeroing that out to come up with what is the most bottom line free cash flow estimate for this company. And I come up with a number that is pretty significant, solid 62.5% of the total free cash flow, equates to about $5.3 billion over the course of next year and a half. So in my opinion, even if commercial aerospace does not come back anytime soon, I think the stock over here, the risk reward is very asymmetric in the long run, with upside on a return of commercial airspace could be as high as back to $80, $85 per share, right, over the course of next year and a half. And downside, I think maybe $5 or $10, and that's even only because if we get further market dislocation, some whiplashes in the market, a new leg lower, and all of this. Now, combining this view with a simple view that I've been talking about for the last couple of weeks, which is there is a potential trigger that's going to happen in my opinion in this market from growth to value. A lot of the stocks that have run up that are part of the growth club that are largely tech stocks, I think they're going to fizzle. And then the value, where some deepest values in this market right now, especially if we have a case that we're going to start to reopen pretty soon, and many of those are industrials and transportation sectors, I think that value will come back, which is very cheap right now. The disconnect between the value and the growth right now, those two factors is very wide. In fact, it's the 20-year dispersion that we are seeing in the stock market. So if that rotation does happen, a name like Raytheon should actually benefit from that. And quickly regarding the option market, if we go to the option chain, you will see that there is 3,400 open interest in the September 60 calls. and there is similarly over 3,000 open interest in the September 50 puts. That was a bullish risk reversal that was bought 2 days ago on May 19. They came out and they sold, if you look over here, they sold those September 50 puts for about $2.60 to $2.65 credit, and they used the proceeds to buy September 60 call options, paying up to $4.50 all the way up to $4.60 for those call options. So September 50, 60 bullish risk reversal for a net debit of about $2. This was done 2 days ago. They continue to be positioned in the open interest. There have been other bullish action in this one, but this was most recent and it caught my attention. So one to watch, see if the market rotates in some of these defensive sectors, particularly the value stocks that are out there. And I could see this thing gradually start to see improving trends from here. So that's it from me. That's what I'm watching. Avo, what you have?
Just we're just a couple of minutes away from the jobs release. There's other data that's coming out. I don't like to buy on days like this because there's a lot of data. I just like to kind of sit back and watch and see how the market treats it, or at least pre-market anyway. So we got Philly Fed also delivering data. Got after that PMI, I think comes out, if I'm not mistaken. Yeah, manufacturing, services, and then existing home sales at 10 o'clock. And after that, we should be data free. And speaking of data, all right, great, you got that, perfect.
Yeah, here's the count. There's a lot of stuff that's coming out. We got the weekly jobless claims, Philly Fed's report at 8:30, then PMI, composite, and existing home sales. And then my favorite, leading economic indicators at 10 o'clock. So that's going to give us some color as well. Yep. So between now and 10 o'clock, there's ton of economic data.
Is there a minutes release today, a FOMC minutes released at 2 o'clock?
No, that came out last night at, yesterday afternoon at 2 o'clock already. We did not cover it as much in the chat room because there was really nothing much to it to read.
Okay. One stock I'm just gonna keep an eye on. I don't like to buy at this kind of price levels, but it's Maycom. We haven't talked about this in a long time. MTSI is the ticker. They've already reported it was a pretty decent quarter actually, and led mainly by data center and telecom. A bit of a decline in the industrial and defense sector. Book to bill was above 1, fourth consecutive quarter. I don't know the exact number, but that was pretty good. And the bookings were driven by a end market demand, weakness in Europe relative to other geographies. But overall, it's doing pretty good. Now, like I said, I don't really like to buy when it's trying to break out for a second time. So this is more of a keep an eye on it, and a pullback might give another good entry point, depending on what the rest of the market is doing, of course. But that's it for now. That's it for today for me.
Sounds good. We'll keep an eye on, see how it pulls back. $28 should be the support on this one on any kind of pullback, so we can always revisit it at that point.
And I just wanted to mention that I forgot. For the next quarter, the company is also expecting a sequential revenue growth. So
okay,
good data came out.
Perfect. Jay, you go next. What do you have?
So I have Texas Roadhouse, TXRH. Yesterday in Jaguar Live, you posted or you highlighted the buyers of 600 July 55 calls for $2.
Yeah.
And then in first read, we see that OI went from 0 to 601. So a small action, but last night there was a note out. The company hosted meetings earlier this week. Stifel was able to gather some thoughts and some of the takeaways that I have. So to start with, to-go orders or the off-premise for Texas Roadhouse. Prior to COVID, to-go orders represented about 7% of total sales. Well, because of what has happened, this number is obviously going to go higher, and the management sees 20 to 25% of to-go orders going forward, or at least for the foreseeable future. And one of the initiatives that the company took at the end of March was they started to offer this ready-to-grill steak offerings. So you'd basically call up your local restaurant, see what kind of cuts they had that day, and then you can place your order. You can do family packs. So this was just, you know, initiative that they put in place. And post earnings, there was a note from JP Morgan that they were the only ones that I think covered this, or at least mentioned it. Texas Roadhouse has always been delivery averse. It just never benefited them. Well, JP Morgan thinks that eventually Texas Roadhouse will be added to delivery platforms. They really didn't give any time frame, but something to watch out for. Now, if we then transition into the restaurant, into the dining rooms, management is looking to have 75% capacity going forward. They've opened approximately 250 dining rooms. At the end of the month, they hope to have more than 300 open. And one of the initiatives that they're taking is to put in these plexiglass partitions on their seating. These partitions are about 16 to 18 inches tall. They're being tested in some locations, but Stiefel believes that the Ohio restaurants that are reopening today will be the quote unquote proving ground for effectiveness. And because Texas Roadhouse has more booth seating than most restaurants, you know, this initiative, this, you know, partition will hopefully get the company to its 75% capacity that they're looking for.
Is that something, 75% capacity, and how much long time frame, generally speaking, from all of these thoughts, in next quarter, by the end of the year?
If I read it correctly, let me see here.
I guess it depends on a lot of how the states reopen as well. I would probably think by the end of the year. Here's what I will add to this view, and a lot of constructive thoughts on that one. But you know, I have actually also read quite a few research pieces on this restaurant here, and my research have also shown that, first of all, this company actually has a rock solid balance sheet, surprisingly, and so this is not in the bad spot as a lot of the other restaurants. And secondly, you're right that the delivery piece has never been there for Texas Roadhouse, and that could come into the picture. So that could negate some of the lost sales. Question still remains though, 3 months, 6 months from now, are they expected to return back to 60%, 70%, 80% of the total previous pre-COVID sales environment? And I think that will dictate the price action on the stock. And technically speaking, you see in your chart in front of you, right? There's significant amount of heavy congestion here between 50 and 55. So if we're going to make a case that this will basically flip back to year-to-date positive gains, and the stock was at around 53 at the start of the year, you know, we need to see that it is indeed on its path to that 75 or 80% capacity in relatively short amount of time, let's say in the next 3 months or 6 months. So confluence of resistance is there, but a very constructive thought process over there. We have to monitor more channel checks on this one. Was that it?
That is it.
Okay, so I want to quickly say that the unemployment claims just came out, and guys, this is not a good number. And again, I'm not as much paying attention to the initial jobless claim. The initial jobless claims are 2.43 million, which is slightly above the 2.4 million expected. It is yet again a very, very ugly number, and I'll share some of those charts in Telegram when I'm done with this. But continuing claim jumped big time. Continuing claim jumped from by 2.5 million. They jumped even more than the initial jobless claims. They went from 22.8 million last week, and now to by 2.5. So put it differently, this is a chart we're just discussing. So last week over week increase was only about 800,000, but this time, and this chart is not updated yet on the Federal Reserve website, now it's went up straight up by another 2.5 million. So that's a hockey stick. That's a huge leg higher. And I think it may have to do with the states just basically catching up to a lot of the claims that were pending because they were running behind. There have been a lot of stories on this one. So bottom line is this makes the unemployment picture in the country right now even worse. Continuing claims are still not stopping. They are still going up sharply. So let's see how the market will react to all of this, particularly the small caps names that are much more subject to volatility based on the unemployment conditions in the country. All right, Chronicle, you go next. What do you have?
Yeah, some thoughts regarding latest flash PMIs that were out overnight.
Yeah.
Overall, manufacturing scores continue to come in better than services. Services PMIs are showing improvement from historically low April-based comparison, but still very weak. We have to keep in mind these are sequential indicators, so to follow up very low April numbers with another very low set of May numbers implies things actually got worse in May, not better. That said, when economies start to reopen, I would not be surprised if June and July numbers start to show some sequential expansions, or at least get close to 50, which would be consistent with a gradual recovery trajectory. Switching to manufacturing, pretty mixed reports overall, with Japan and Australia worsening while European reports are showing noticeable improvements. In Australia, manufacturing sector output and export orders fell to a record low. Exports in Australia are mostly made up of materials going to China, and so I think this gives us a good picture of how the recovery in China is actually going. And staying on the topic of export orders, it's the same story in Japan, where automobiles and related parts make up a quarter of exports. So that's telling us demand for vehicles is still weak. And this can also be seen in Europe, where German flash manufacturing has shown less improvement than its neighbors across the Eurozone. So yeah, to sum it up, manufacturing is still better than services, but I continue to stay away from the automobile industry. That and China is still not fully operational, judging by new export orders from the APAC PMI reports.
Are you
Looking
surprised? Sorry, quick question. Are you surprised that China now has been open for nearly 2 months? Traffic trends and all kinds of things have been improving. I've been talking to my father also. Every week I talk to him and he tells me a lot about it. But are you surprised the really very slow and rather boring recovery that we are seeing in China, even after 2 months of opening? Doesn't seem like we're seeing some big, thick green shoots there in the economic data. It's rather, it's not huge. It's just very slow.
not overly surprised, because I was looking at Morgan Stanley surveys 2 months ago that pointed that to people not being as willing to come out and spend time in public, even though COVID-19 had been contained. And second of all, I haven't really seen a lot of stimulus coming out of China apart from rate cuts.
Okay. All right. More to add?
No, but I think the flash manufacturing for the US that's coming out this morning will be one to watch.
Yeah, that would be interesting one. For my sake, just to tie up those, the point about manufacturing is doing better, relatively speaking, than services is a very important point. And I'm just going to tie that real quick one more time to what I have been saying, which is that the growth is very, very expensive in this market, and the value at which a lot of that happens to be industrials and transports are very, very cheap in this market. Okay, and I think that at some point people are going to see through this, and they're going to realize that manufacturing is indeed making a comeback relative to services at a better rate. And I think that means that growth to value rotation could happen, may have already started. Looking at this VTV chart from 3 days ago when I started to talk about it far more. So this is the Vanguard Value Index, and quickly putting a technical take on this one. If you see this, this $100 level essentially is a major VOP resistance. If we break out through that in VTV, it opens us into this major air pocket all the way up to $607 per share. So for the value index to move of that magnitude by almost 10% from where it is right now, if that were to happen, you've got a lot of names that can go 10, 15, 20% higher in a very short amount of time. So RTX, the one that I just discussed, is another one. This one, General Dynamics, another defense contractor that sets up for breakout. UPS, which we're still working on, and we're going to present some bull case on this in Jaguar Media shortly. So all of these trends could be in play because this is the depressed part of the market where there's not enough attention as there should be if there is a rotation from growth to value. So we're going to end here, and we'll have more thoughts about all of this in the chat room shortly. Thank you, everyone, for joining. See you soon.